Happy holidays, everybody. This is my Post-OPEX recap. It's been quite a week for the markets. We had the biggest down day the whole year at 3% down after that FOMC decision. Today I'm going to explore three things. First off, I'm going to explore the footprints leading up to this big steep drop and the volatility that was implied through the term structure and customer positioning. And then we're going to go really dive deep into the day and the positioning into the drop. And then we're going to go look into the positioning of today's term structure and today's gamma exposure. So leading up to the drop, we could see clear signs in vol with the term structure, with my skew embedded term structure, that volatility was coming. If you look at the spread between the 25 delta put and the at the money vol, we can see that the spread is greatest and is increasing after that 12/17 expiration, leading to the FOMC decision. We can see that the 12/18 here, that the put volatility has increased dramatically, and this was on December 9th, days before the FOMC decision. And then fast forwarding to this Monday, the 16th, we can see that the term structure has showed that vol has actually increased for the 12, 18, 19, and 20 expirations. If you just line it up, you can see that it did increase. So we're seeing signs of backwardation starting on 1209. You can see that we see a vol peak and a vol low, vol peak, vol low. And these are signs that backwardation is here and that volatility is coming. So we could see on 12/16 that the 12/18 vol was significantly raised, especially on those 25 delta puts. So a trader could see this on Monday. Think about where we are in the last 2 weeks. We're in that Vanna charm window. We haven't seen much strength. We've just seen consolidation at all-time highs, and now we're seeing a spike in implied vol approaching on that 12/18 FOMC decision. So what does this mean? It means that you are most likely most successful gonna be, sorry, I said that really weird. You're most likely gonna be successful if you stay hedged through the FOMC decision, only because a lot of signs from vol and the current positioning are showing that any weakness into the FOMC decision could really exacerbate selling flows. So now let's dive into the specific positions on the FOMC day based on our awesome options dev tool, which shows our breakdown by strike, exposure by expiration, and you can go to specific timestamps. So 10 minutes before the drop started, we can see that customers are short put and long call, meaning it's a very bullish sentiment in the market leading up to the FOMC decision. This makes dealers long put and short call. Both are hedged with long stock. Now this long stock has to be sold off if customer positioning is starting to withdraw from the market, meaning that short put positioning is starting to get bought back, meaning dealers are less susceptible to risk, so they get rid of their long stock hedge, right? Because if there's less options that they have to warehouse, then there's less risk that they have to warehouse accordingly. So we can see after we broke that 6052 gamma level, we just saw, the staircase below. So yeah, and you can see that traders weren't hedged for this at all, just from the positioning as well. But if you just look at the put call ratio, moments before the FOMC were at all-time lows for the year. So it's safe to say that traders were not expecting the magnitude of this FOMC drop. Um, the main narrative during this election up year has been buy the dip, and that's worked so far. But it seems like based on these technical indicators that a bigger drop is incoming after this continued bounce. So we'll get into that based on the current term structure. But let's fast forward to December 20th's term structure. Sorry, gamma exposure. So let's go to the beginning of the day. We can see at the beginning of the day that dealers were positioned long call short put, which is your traditional risk reversal dealer position, where customers are long put and short call to capture that premium and have that downside insurance. So you can see after we broke above that 5850 short gamma level and that 5900, we saw a pretty clear path up with Vanna with charm flows aiding into that delta decay and aiding into that buyback. Because both of these positions that dealers are holding, the long call, short put, are both hedged with short stock. So this has to be bought back into expiration. So as time passes, theta eats away at that delta, and they have to buy back the stock into expiration. Now let's kind of look into why we closed at 59.30 instead of lingering around this 59.7 level. It's because leading into the close, there was significant long gamma exposure by dealers around this 59.30 strike, which is why we got pinned around there. So with that pretty good bounce off the lows, what can we expect for the trading year going forward? For that, let's look at the 12/20 term structure. And let's also think about where we are in a seasonal macro context. The BTFD mindset of 2024 has worked out very profitably because of the incentive the Fed has to prop up markets into election years. During election years, they have historically very positive years, with the Fed cutting to accommodate that. So in every inflationary election year, data sourced from Jem Carson, from 68 to 82, every election year has 21.5% up on average. So statistically, this year was very bullish, but years after that, in those inflationary periods, average around 5%. And seasonally, January sees a period of weakness looking at seasonal charts. So let's pull up Rater reports. Yeah, don't mind that. Tools, seasonal. Let's look at SPY. Sorry, let's let this load. We have dark mode now. Huh. Okay, well, let's just open our own seasonal tool. So let's do that. It'll run in a second. Oh shit. My bad. Alright, so we see starting from December all the way to March, we see a period of weakness after that strong period of October to November. So you can see statistically the years following January are pretty weak into February and March. So that's where this whole thesis of the decline after the end of year re-leveraging flows. So as fund and wealth managers have increased asset values, they have to risk adjust based on that new collateral value. So there is going to be a few $1 trillion pump, not all in one day, but the last 2 weeks of December into the first 2 weeks of January, we should see some supportive flows that support this bounce back up. But ultimately, I do think there is going to be a decline after that bounce up, um, just because, you know, of the statistics, and we're in line for a correction. It's been a hell of a year, but it's time to correct things. And you can see based on the 12/20 term structure, so the current term structure for today, that volatility is increased into January OPEX and steadily increases after that Jan 1 expiration. So I am seeing, predicting some weakness early mid-January. I am gonna hedge with any bounces and start scaling out of longs. Uh, Optimally, I would want to exit out of all longs at 600 and just, secure all previous profits and current profits. And yeah, just stay hedged. I am gonna predict some weakness, but we'll see the data going forward. So that has been the December OPEX weekly recap. Thank you for tuning in.